Okay, in this particular segment, what we want to do is create a commercial bank. We're going to call it the Wahoo Bank, and we're going to go through a couple of these T accounts via the asset and liability T accounts, and we're going to talk about how the money changes and what have you. So the Wahoo Bank, we open up a bank. In order for us to open up a bank, we need cash, and therefore we're going to sell common stock worth of $250,000, and we're going to simply put that into an account over here, into an asset account that we talked about earlier called cash. Because it is a balance sheet, the left side must equal the right side, so we have $250,000 in cash. We have our net worth or common stock of $250,000. In the second T account, in the second transaction that we have, we're simply going to take some of our cash and we're going to buy property. We're going to buy some land, we're going to build a bank, we're going to buy some computers, we're going to have some plexiglass to protect us against crooks and what have you. So therefore we're going to take $240,000 of our cash and we're going to buy all these goods. And that leaves us with $10,000 in cash left over, which gives us an asset of $250,000. All we did was just change the composition of our cash from the initial position by simply purchasing property and what have you. And our stock is the same amount, which is $250,000, and they do equal. So we are still in compliance with the Fed. The third transaction, we're now going to open up our doors on Monday morning and start to take in deposits. The primary goal of a commercial bank, cutting through all the red tape and all the different services that a bank has, basically when it comes down to it, the bank has two functions: to accept your checkable deposits, your demand deposits, and two, to make loans. That's it. And that's really all we're going to concentrate on. So therefore, in our third transaction, we're going to open up our doors and we're going to take in $100,000 in demand deposits. Remember, a demand deposit is a deposit that is payable on demand. It is a liability to the bank because it owes you that money on demand. All right? And therefore, because we added $100,000 in our demand deposits, we're simply going to put this into cash. And because we had $10,000 in our previous transaction, our current cash position is now $110,000. Our property is $240,000, which now means that our asset position has grown by $100,000, the exact amount of the demand deposits, to $350,000. And our stock is still $250, so therefore we have $350. Assets equal our liabilities, our demand deposits, plus our stock or our net worth, which is $350, and we are in compliance. The next transaction that we'll have is we're going to join the Fed. Now, in joining the Fed, we have to comply to certain policies, certain rules, if you will. One of those rules is we have to now be subject to what we call a reserve requirement. And if we go back to the concept of the fractional reserve system, we can see this. Remember, the fractional reserve system was the concept of taking deposits, holding a little bit for you, for the person who makes the deposit, and lending the rest out. And now we're going to, because we joined the Fed, we are now subject to that reserve requirement. In order for us to calculate our reserve requirement, we have to come up with what we call a reserve ratio. The reserve ratio is a percentage of the funds that the bank must hold as required reserves at the Fed. Now, they can just keep it in their bank drawers or in their vault if they want. But it is a certain percentage of those funds that must be held as required reserves at the Fed, but it is based on, shoot, I didn't put it up here. The reserve ratio is based upon the demand deposits that you have. It is held as required reserves at the Fed. And therefore, let's assume our reserve ratio is 10%. That means that the bank must hold 10 cents of every dollar in demand deposits that it has. So in this case, if it is $10,000, 10%, and it has $100,000, the reserve requirement in this case would be the required reserves would be $10,000. So therefore, we're going to eliminate this term cash. We're going to call that zero since we now join the Fed. And we're going to simply take all of our cash money of 110 and put it into what we call reserves. And we want to take a look over here for a minute. We see that our total reserves, which this represents total reserves, is equal to our required reserves plus our excess reserves. So if our reserve ratio is 10%, we have $10,000 as required reserves. That means that we then have, of this 100, we have $90,000 that we can lend out. I'm sorry, I have these. Sorry about that. There we go. Now we're set. I have $90,000 of this $100,000 that I can now lend out. No matter what happens, if this is the reserve ratio and these are the demand deposits, I must have $10,000 or 10% of that, if that is the reserve ratio. I cannot go below that or I am in violation with the Fed and I can be subject to penalties. So it is incumbent upon us to be sure that we have that reserve ratio there. The second important issue in this particular transaction is through this reserve ratio, is one of the primary ways that the Fed can control the money supply, but by either putting more money into the system or taking money out of the system. And the last thing is that we have to understand now that these reserves are an asset to the bank, but it is a liability because remember, one of the functions of the Fed is that it is the banker's bank. This is where the banks keep their money. And therefore, they send this money to the Fed, and therefore it is a liability to the Fed, but it is an asset to the bank. And the Fed must give the bank those assets, those reserves, if you will, on demand. It's like a check from the bank to the Fed. So these are the first four transactions, but these are all particular interest to you, and you really need to have a firm functionality between each of these particular points, especially in number 4, because as we move forward, we're going to see how all of this impacts on the money supply and the ability to lend money. Thank you very much, and have a good day.